From the financial centers of the world, this is Bloomberg Markets with Alix Steel and Guy Johnson.
Friday the 12th of November, 3 p.m. in London, 10 a.m. in a soggy New York, 30 minutes into a soggy trading session in the United States as well. I'm Guy Johnson in London. Alix Steel is over in New York. Welcome, everybody, to Bloomberg Markets. Alex, we're about to get something of a data deluge that could be quite informative, I think. I'm really looking forward to the inflation component of all of these numbers.
Yep, and Jolts and you, Mish, will break that in just a second. See, unlike Guy, I'm not going to talk about the weather, but I am going to talk about the markets. S&P pretty much flat, but you do have materials doing pretty well, tech doing pretty well within the S&P, but it does feel soggy if we look at it that way. I do want to point out, though, the dollar, because that, along with yields, has been quite interesting throughout this move. You're looking at the Bloomberg Dollar Index, the highest since November 2020, and many analysts are looking at 114 as the kind of the line in the sand for euro dollar. That really sets up whatever central bank divergence that we're actually seeing, which leads us to the bond market and those inflation expectations. 30-year yield up by about 2 basis points, underperformer at the long end of the curve. The belly was getting hit earlier in the session, but now it feels like the selling is moving to the back end. Crude also down by 1%, but I wanted to highlight that because apparently there's a really big options bet right now in the market, Guy. Oil equivalent of 5 million barrels of Brent, call spreads of $250 to $300 call spreads. They traded yesterday. That's a really big bullish bet potentially on where the prices could go.
Well, that would take us back to the 1970s, and that would take us kind of beyond the 1970s. The 1970s, obviously, the huge oil shock, that would certainly be an oil shock. That would be an inflationary story for us to get our teeth into. Talking of inflationary stories for us to get our teeth into, let us delve into the data and dig in to the University of Michigan Consumer Sentiment Survey that is hitting the screens right now. Headline number, 66.8. That dips a bit, but the breakdown is important here. That's down from 71.7 and below the 72 expected. But it's current conditions that are coming off, 73.2 down from 77.7. Expectations also dipped to 62.8, and then we get to the kicker. Basically, one-year inflation expectations up from 4.8 to 4.9. The longer-term 5 to 10 story stays at 2.9, but nevertheless, one-year inflation, this is what's going to be worrying the president, Alex. The consumer is expecting much more still to come, and for it to continue, and that is probably going to be what is hitting a current and expectations lines in this data.
Yep. 100%. In the meantime, that's kind of the look on sentiment. Let's get the look on the jobs market. So the JOLTS jobs openings came in higher than expected, but sequentially did fall in September. Now, this is 2 months old, but it does give a good indication here, coming in at 10.4 million job openings, whereas you had August revised up to 10.6 million job openings. So the openings falling just a little bit, but if you look within it, retail and those kind of industries, those service industries, lots of jobs openings there. So we'll bring you any more details as they cross. So what do you do with all of this as we're headed into the end of this year and then in 2020? Well, luckily, JP Morgan released its 2022 long-term capital market assumptions, pairing a gloomy picture for the global economy. Now, one excerpt reads that the reality of weak demographics will continue to weigh on economic growth across both developed and emerging economies. Joining us now are two of the people behind that report, David Kelly, JP Morgan Asset Management Chief Global Strategist, and Gabrielle Santos, JP Morgan Asset Management Global Market Strategist. I'm going to start here because Gabrielle's on set, which is very exciting. So the bigger takeaway, I think, here, when we're going into a world of higher inflation, higher rates, and a higher dollar, and record high stock markets, what was the biggest takeaway or surprise when you went through the report?
So it's great to be here, Alex. I think actually I would lead with a different headline in terms of our takeaway for the economy. It is weaker growth than we had, let's say, 20 years ago because of weaker demographics, but it's actually much better than it could have been. We see very limited scarring from the pandemic, and we're actually optimistic about upside going forward, given all of the productivity gains that we've seen during this time period. There's also been so much monetary and fiscal support that's likely to continue to provide a boost to overall nominal growth. I think what's the most surprising thing to us is if you compare the beginning of this cycle versus 2008, we're starting already with much higher valuations for both equities and bonds. So it's really the return figure that's very gloomy. It's only 4.3% for a 60-40. So we have to do better than that. Look at different asset classes, look at different markets, think about alpha. That's the way to get the returns that clients actually want and need during the next cycle.
David, let me bring you into the conversation. So we're going to get 4% off a 60-40, circa 4% off a 60-40.
Yep.
What kind of inflation rates am I going to be dealing with? How much is inflation going to eat into that return over the period you're talking about?
A little bit higher. In the U.S., we've pushed our inflation forecast up from 2.0% to 2.3% over the next 10 to 15 years. But I do want to emphasize that this does essentially mean that we're saying we think most of this is transitory. It's obviously an inflation scare right now. We've got a lot of supply chain disruptions. We've got a lot of fiscal and monetary policy pumping through the system. But a lot of the things that have kept inflation low over the years, the decline in the trade union movement, increased global trade, increased inequality, we think those will probably stay in place. So we're looking for a small upgrade to long-term inflation expectations, even though we're seeing a very big upgrade, obviously, in the current numbers.
So, David, hey, it's Alex. It's good to see you. So let's get to that 60-40 portfolio then that Guy was just talking about. So you guys see high volatility, but still a return of about 4.3%. You do say that you could see it get to 7 if you kind of allocate correctly. Can you walk me through your allocation, David?
Well, yes, I think the key here is to recognize that the things that people are overweight in right now are really the areas that we expect to see pretty slow growth. So U.S. equities giving you only about 4.3%, or sorry, actually 4.1% over this 10 to 15 year period. Corporate bonds giving you less, cash giving you less, treasuries giving you less. But once you go outside the United States for a U.S. investor, we think there are better returns overseas, and those are going to be amplified by what we think will be a falling dollar over the next 10 to 15 years. So now you're talking about numbers in the 6, 7, 8% range, particularly when you look to emerging markets. And then also, if you look at some alternatives, there are plenty of alternatives: real estate, infrastructure, global transportation, some private equity, private debt. These can all give you better returns than a plain vanilla 60-40 portfolio. So it's really, we have been in the sort of in the world of beta for the last few years. Momentum has really carried you. You didn't need to do much thinking. We think this is really the dawning of the age of alpha. This is a time when you've got to look outside the box and think about where the misvaluations are, because this pandemic has left a lot of things really weirdly valued relative to each other. And that's true in terms of asset classes, which I just mentioned, but even within portfolios. I mean, the top 10 stocks in the S&P 500 are trading at over 30 times earnings. The rest of the whole market in the S&P 500 is trading at about 20 times. So I think this is a time for active management within portfolios and also really thoughtful asset allocation.
Okay. So you've got to look at, we've got some weird valuations. You've got to look more outside the United States. Emerging markets are going to be an increasing feature of a successful portfolio. Gabriella, is China in the box or is China outside the box? Can I ignore China, or do I have to include China in terms of my asset allocation here? Because a lot of people are scratching their heads trying to figure out the answer to that one right now.
Guy, we absolutely have to include China. And here we're talking about onshore Chinese equities and Chinese bonds. One of the big theme papers we wrote in this year's long-term capital market assumptions was about the growth and the potential of Chinese onshore markets. They have superior returns, they have diversification benefits, so they really help the risk-adjusted portfolio. And we did a study. If you just have a 50-50 portfolio, let's call it 4.8% return expected, you add Chinese onshore assets and you can boost that to 5.8% without sacrificing on the volatility. So we want to take this opportunity in a tricky year for China to underwrite the view that more and more China is going to be a key structural growth part of asset portfolios.
So still, even though we're getting, like you mentioned, a tough year, property restrictions, crackdown on tech, it's still going to provide that boost?
Yes, and we are very much in the midst of a new reform cycle here in China, but we've been here before. The volatility we've seen this year is business as usual. Investors go through existential crises, then they adjust to the new reforms, and we move forward. And they don't all net out to positives for Chinese onshore assets, but you can still pick up significant returns over what you can get in other equity and bond markets. And it's all about really the growth of the markets and their tilt towards new economy sectors, their growing institutionalization, and their continued openness to foreign investors.
David, we haven't mentioned Europe yet. I looked at the earnings season. It was really solid. In fact, I think it surprised people by how solid it was. The Eurozone doesn't seem like it's got an inflation issue, probably doesn't have the growth of the United States. But how much do I want to allocate to Europe? How much do I want to allocate to the UK?
Well, I think there certainly is a good opportunity in terms of valuations right now. I mean, we're seeing a situation where broadly equity markets outside the United States are about 2 standard deviations cheaper relative to the US than they have been over the last 25 years. So international equities in general are cheap. And the thing about Europe, and this is also a little bit true of Japan, is they're actually quite cyclical. If you look at the structure of the market, the cyclical sectors are much more dominant in Europe and Japan than they are in the United States. So we think we get a tactical, we sort of see a cyclical rebound. It is true that the long-term growth story for Europe and the long-term growth story for developed countries outside the United States is also pretty slow in terms of economic growth. We think that's right. We're also looking for a little bit of a productivity boost, though, really across the developed world as we grapple with labor shortages. And I think that's another theme in the long-term capital market assumptions. We looked at, how can you implement labor-saving technology with rates low, with profits high? This should be a very good period for capital spending and enhancing productivity. But certainly there's a short-term opportunity for cyclical reasons, and there's a valuation opportunity. And finally, we think that both the yen and the euro will appreciate relative to the US dollar over the next 10 to 15 years, and that will amplify the return from those sectors. So they're very unloved, they're very unheld, but I think this is a really important opportunity if you want to get out of that sort of 60-40 trap of mediocre returns in the long run.
10 to 15 years, that's a pretty solid outlook. I don't even know what's going to happen tomorrow. I wonder, though, in the short term, central bank divergence is going to really take front and center. We've seen that play out in the bond market and the FX market just in this last week. David, and I wonder how you see that evolving and how that kind of leaves certain central banks behind in some ways.
Oh, I think it's... I don't think that it's going to last for that long. Again, it actually is very refreshing when we sit back and think about 10 to 15 years, because then you can just get through some of these cyclical issues, some of these political issues. Right now, the U.S. is looking like it's going to tighten and or more aggressively, and Europe and Japan are certainly lagging behind. But we do expect to see some more inflation there also. And we think, there's no reason why U.S. monetary policy should be tighter in the long run than European and Japanese monetary policy. So we think they'll catch up, and certainly over the course of 10 to 15 years, our massive trade deficit will tend to push the dollar down also. And I think, Gabrielle, I know you've written on the fact that there, in emerging markets, there are a lot of countries who are being forced to actually be much more aggressive in monetary policy overseas than we are here in the United States.
That's true, and China is not necessarily one of them, actually. And I think that really emphasizes how Chinese bonds really beat to their music of their own drums, as opposed to following the U.S. or other central banks. And that adds to the diversification benefit, actually, of holding Chinese onshore bonds, which have some of the best Sharpe ratios around.
All right, guys, we are going to leave it there, but we really appreciate all of your time. David Kelly and Gabriela Santos of JP Morgan Investment Management, Asset Management, I should say. Thank you very much. Appreciate it. Guy?
Yeah, really appreciate it as well from over here. Alex, it's been breakup week, hasn't it? We've had GE. Now we need to talk about J&J. Johnson & Johnson breaking up Band-Aids and pharmaceuticals. We are going to be speaking, or David Weston, more importantly, is going to be speaking to Alex Gorski. He is the company's chairman and CEO. That conversation next. This is Bloomberg.
From Bloomberg World Headquarters in New York to our TV and radio audiences, I'm David Weston, and we want to now welcome a very special guest today. He is Johnson & Johnson's chairman and CEO, Alex Gorski. So, Alex, thank you so much for being with us. You had a very big announcement this morning. You are breaking this iconic company into two pieces. Johnson & Johnson was known for forever as being very proud of having both the consumer side, a little less return, but a little less risk, and the pharmaceutical side, more return, but also more risk. You wanted them together. What made you change your mind? This is a really big change. It's a bigger one than some other companies might have.
Well, David, first of all, thank you very much for the opportunity to have a conversation today. And you're absolutely right. This is a historic day for Johnson & Johnson. But this is something that we've been looking at for years, that we've given a lot of reflection and careful consideration to. And look, we've long said that our diversified portfolio strategy was one that was, founded based on where the markets were going, where we saw innovation going. And as we've seen things switch in a pretty significant way over the last few years, we think that it was important to make this announcement today that, in fact, we're going to separate our consumer division to form an independent publicly traded company. And look, there's a lot of factors that playing into it. And some of it has to do with the way innovation and technology has evolved, the way the consumer channels, particularly e-commerce, has changed. COVID-19, we think, also brought about a fundamental change in the way that the people, that families think about personal care. And when we compare and contrast that to our pharmaceutical and medical device portfolio, we just felt that this was the appropriate time so that both these new companies can really accelerate their growth, can reach even more patients and consumers, can be more targeted in their strategies and execution and capital allocation, and ultimately create more value for all stakeholders.
So as you say, Alex, both of those businesses though, have really changed a lot, both the pharmaceuticals and also the consumer-facing one. Before we talk about the markets, though, tell me about the finances of it. Johnson & Johnson's always been very proud of its AAA rating. Do you think you're going to keep that rating? And maybe just as important, is it not as important to have that today because of low interest rates projected out into the future?
Well, we do think it will be maintained. But look, we've also always said the AAA rating was not in and of itself a goal of ours to maintain. Rather, it was a reflection of the way that we run our businesses at Johnson & Johnson. And I think what's really important at this particular moment, David, is that we're doing this from a position of strength. In fact, if you reflect back just at our last quarter, all three of our businesses are operating at very strong competitive positions, growing at a rate faster than the markets in which they compete. We've been growing share. The pipelines are stronger than they've ever been. And so we think this is, again, in a way to unleash additional growth across both companies as we go forward.
Alex, talk about that, what I described as high return but high risk part of it. That is the patent-covered medical treatments, both devices as well as prescription drugs. Does this free up cash to invest, more cash than you otherwise would have to invest? Because those are very expensive.
Well, David, the way that we try to manage our business for the long term is one where, we're always looking for that next level of innovation, because we understand that whether it's patent expiries or the launches of biosimilars or new products just introduced by different competition, that is part of our daily business. And so when we do our planning, we're always trying to think 3, 5, 10 years ahead. And if you look at the track record that we've had in our pharmaceutical business, for example, whether it's been over the last 10 years, 5 years, or 3 years, in spite of literally billions of dollars of losses due to those other types of patent expiries or competitive launches, we've been able to maintain an above-market growth rate based upon the innovation, the new product launches that we've been introducing throughout that period. We take the same approach with our medical device. And again, we think both of these businesses have the potential to be growing at least mid-single digits and above going forward. And we think this is going to better position our consumer business in this evolving environment that I mentioned earlier to be even more agile, more flexible, and even more innovative to reach more consumers around the world.
I want to come back to consumers, but just to stay for just one moment on what I'll call the pharmaceuticals and the medical devices. Do you anticipate it will be a faster rate of growth because it will not be held back by consumer?
Well, look, part of all of our objectives here is to accelerate growth. And so absolutely, that's part of our goal here. And look, we see that possible by just being, again, more focused, being able to even better allocate capital, to have a better balance, perhaps in some cases, between the corporate and the organizational structures. And we think that by allowing each of these businesses to take that path forward, that they'll be more successful both on the top, but they'll also be able to be more effective and efficient on the bottom as well.
Alex, I wonder on the consumer side, as you said, the markets have changed. One of the things I think I've seen at least is how much social media, TikTok influencers, things like that are driving consumer products in sort of some of the areas that you're in that didn't happen before. Is that part of the decision here, that that's sort of an odd thing for the traditional Johnson & Johnson?
Well, look, we are seeing the way that consumer products are being introduced and developed has evolved. We've always tried to take a very science-based approach that's professionally endorsed by, for example, physicians and other thought-leading experts. And we think having that fundamental underpinning in science and technology is really important. But absolutely, we think by being an independent unit, it's going to give the consumer group an even greater level of flexibility and agility to make sure that they stay competitive, as that environment continues to evolve. And you're also correct, like, the whole e-commerce world has changed. It makes up a significantly higher percentage of our business. We've grown at a very solid rate in those areas, but we expect that to continue to accelerate going into the future as well.
Alex, one of the issues you've had on your agenda has been the talc liability, the potential liability out there. You've got various structures, legal structures you're trying to deal with, but it could be rather substantial. Does that stay with the consumer part of the business, and will it be capitalized enough to handle that?
No, look, this is really about the future. We've been very clear in all of our filings and all of our public announcements about the legal strategies that we have in place. But this is about, again, really unleashing our consumer business as an independent, publicly traded company going forward. And we think it's an exciting time for them. And we'll, as I mentioned earlier, improve our pace of innovation, our ability to execute, as well as prospects for the future.
Alex, just to make sure I understand, I think what you're saying is that your strategy with respect to the talc liability will not be affected by this division of the two companies. Is that correct?
That's correct.
Okay, Alex, fine. I'm going to ask you a rather more personal question. You and I have talked a lot about the Credo of Johnson & Johnson, how important that is to you, how important it's been to the company. Who gets the Credo between these two countries?
Look, David, I hope everybody would take the Credo. You think about it, it's very consistent with really in today's environment what the purpose of a corporation should be by placing patients, by placing consumers who use your products first, by taking a very inclusive look about what are we doing for our employees at the same time. And by the way, I'd like to get a shout out to all of our employees across Johnson & Johnson, particularly those in our consumer group, because without their hard work and their commitment, this would not be possible. To think about our communities as we're making these decisions and the impact that it can have, and ultimately to our shareholders. So, we think taking a Credo-based approach is in every company's best interest.
So, Alex, you talked about your shareholders. We haven't talked about those much. How much of the decision to do this has been an ability for shareholders to make more informed, targeted decisions on which of the businesses they want to invest in, consumer or the higher profile pharmaceuticals?
Well, David, that's one of many factors. But again, I think it has to do with how do we make sure that, our strategy is evolving, that while it's tied to what our strategy's been in the past, and it's not anchored there, that we're constantly evolving. I mean, this is a big, bold move. And we think it's consistent with the way that we're seeing, the market adjust going forward. And as a result, we think both these companies are going to be more competitive, better positioned to really help more people around the world.
It's a big, bold move. How long will it take? And in the meantime, how does the Johnson & Johnson management make sure that your employees stay focused? Because you and I have been through situations where it's easy to get distracted. It consumes a lot of management leadership bandwidth.
Well, look, I've been very proud of the way that our teams in all of our sectors have responded and stepped up through this COVID period. I mean, it's really interesting, David. If you look at our financial performance, if you look at our competitive shares, if you look at our R&D pipelines, our innovation index, if you look at our internal engagement scores, all of those have actually improved during an incredibly challenging time, for our industry, let alone the company. And so, again, we think that we are better positioned today than we were even 24 months ago. And look, we see actually the way that we're considering the financial implications as really an outcome of the way we're fundamentally running the business. If we innovate, if we execute, if we're taking a stakeholder approach, the results are going to drive themselves, and we think our shareholders will ultimately recognize that.
Alex, thank you so much for taking a few minutes out of a very busy day. That's Alix Steel. He's Johnson & Johnson Chairman and CEO. Back to you.
All right, thanks so much, David. Really appreciate it, David Weston, bringing us that J&J interview. J&J stock is up by about 1.4%. It's just so interesting that it comes on the heels of GE splitting into three businesses, obviously totally different sectors, but it does feel like the era of the big business in traditional potentially maybe over, at least here in the U.S. Now we kind of look at tech for that. All right, well, coming up, let's go to tech. Could the worst actually be over for the global chip shortage? We're going to get some answers from Kurt Sievers, NXP Semiconductor's CEO. They had a long-term growth outlook report yesterday. We'll talk about what we learned and what their view is of 2020. This is Bloomberg.
Half past the hour, live from London. I'm Guy Johnson, Alix Steel over in New York. This, folks, is Bloomberg Markets. Alex, NXP Semi is depending on the auto industry for its future, and things are looking pretty good despite the current chip shortage. Let's deal with the details of where this sector and this company are going. Abigail, over to you.
Well, Guy, things are looking very good for NXP Semiconductor. Big quarter, big beats on both the top and the bottom line. Adjusted earnings beat by 36%, putting up a little bit more than $3 per share. So not a small number on about $3 billion in revenue. That was a 20% beat. Not so shabby. In fact, pretty great. Now, if we take a look at revenue, because this is even the bigger story on top of a great quarter, the forecast. Now, you can see 2018, 2019, and 2020, a little bit of a dip to $8.6 billion, but up and away. The 2021 right now estimated to be $11 billion. But if we go forward a couple of years, and that's what you generally want to do, be looking forward, $15 billion. That's 36% growth. Really pretty incredible. Now, what makes this so interesting, especially relative to the last quarter, automobiles, where we're hearing about all these chip shortages, largely in line, about $1.5 billion worth of revenues, more than 50% of the overall sector pie there. Interesting, though, Alex, if we take a look at the lead time between the order and when it actually comes through the chip, we are going to see that there's a really pretty decent lag there, up here in 2021 to greater than 5 months. So that's one of the challenges, of course, that has to be managed at this point. But right now, NXP Semiconductor really seems to be doing a great job of that, Alex.
All right, Abigail, thanks a lot. Really appreciate that setup. It's a nice thing to get that set up there. Also, they had their investor day yesterday. Kurt Sievers, NXP Semiconductor's president and CEO, is here with me on set. This is your first trip outside, right?
Yes, absolutely.
That's exciting.
Just getting on the road again.
So you had that investor day yesterday, and you were quite bullish. I mean, you're looking at sales that could reach $15 billion in 2024. You're looking at a compound annual growth rate of as high as 14% over the next 3 years. So there's a lot to unpack. Just in terms of, say, the automakers and chips there, when does the shortage end?
I guess it's going to get better through next year, but I don't think everything is going to be in balance from a supply-demand perspective through the end of next year. So there is still some quarters to go until it's coming back. But I have to remind all of us, I mean, we are shipping like crazy. You just showed a few numbers. Let me put it in perspective for automotive. It's even more extreme. We will grow this year our automotive revenues by 45% over last year. Now you might want to say last year is a difficult compare because everything was down, but it's still going to be 30% above our revenues in automotive in 2019. So if you compare to the pre-pandemic period, this is a 30% growth from a year-over-year perspective. So supply is going up every quarter, and as part of the forecast which we just seen, automotive is actually going to grow 9 to 14% compound annual over the next 3 years, which is a massive growth. So I think we do a lot for the auto industry, but I have to admit there are still shortages in places.
Kurt, this is an industry that is well known, though, for peaks and troughs, for booms and busts. You're pointing to a very positive picture. Are we at peak growth now? Do we stay at peak growth? Is this cycle going to be different? Is the shape of this cycle going to be different? I.e., can you sustain peak growth for a long period?
I really think we are just at the beginning of a longer-term cycle, at least for the businesses we are exposed to and we are focusing on. We really look after secular growth drivers, especially in the automotive and industrial markets, which is like 3/4 of NXP's revenue. And in the end, it's really about this edge computing theme. I mean, in our analyst day the other day, we talked about this. I think the next 10 years of semiconductor market growth will be characterized by what we call the rise of the edge, which is applications which are all about us, connected to the cloud. And the compute performance, the connectivity performance does allow these applications actually to boom these days. So, Guy, no, I don't think we are at peak here. We are actually starting a longer-term, pretty sustainable growth cycle.
So to that point, Is it that there's just going to be more stuff that has chips in it? Or is it going to be that the stuff that we have with chips has more chips in them?
The latter. It is really
Okay.
that things you are used to operate with will have heavier silicon content, because what they do is they have face recognition, they have voice recognition, they are connected to the cloud, they have better activation algorithms. Think about a car. I mean, the car, in my view, is the ultimate edge node. The kind of convenience, safety, but also CO2 savings a car is allowing today is just bar none. And think about electric cars. An electric car has twice the semiconductor content of a combustion engine car. Now you see the fast pace in acceleration going to electric cars. This year, I think the world is going to see 20% of the global production already being electric. We forecast 60% by 2030. And again, each car which is converted from a combustion engine car to a truly electric car is doubling the semiconductor content. So it's really about content. It's not more devices, but it's more content per device.
Where are the gaps now that are open as we make this transition from ICE to EV? What do EVs need that are different to the ICE cars? And where do you need to invest to fill those gaps?
Well, the biggest difference clearly is the electric drivetrain. I mean, you get rid of the conventional powertrain, which was more about metal and stuff, and it's replaced by an electric drivetrain. And NXP has a sharp focus here on the e-motor control and the battery management solutions. In the end, to keep it simple, this is all about solutions which are extending the range of the electric car. In my view, and I say this also from a consumer perspective, I think the biggest mileage electric cars still have to go is range extension. I just want to feel independent driving an electric car, and that is all about semiconductors. I mean, it's nothing but semiconductors achieving that. So we are investing heavily in this field, going to grow 30%. We've just seen the overall semiconductor growth of NXP over the next 3 years. If you zoom into our electrification systems for electric cars, we're going to grow 30% over the next 3 years.
What's your CapEx for that?
Well, I couldn't say it specifically for this because we co-use technologies into different segments.
But overall, I mean, you're going to be making a lot of investments.
The CapEx for the company is actually moving to 10% next year on a sharply growing revenue, which is about twice the rate which we've had the past years. And that's also a big commitment, Alex, to the chip crisis, if you will, because that CapEx all goes into the capability to ship more in the coming years.
Do you think you're going to have problems with getting the kit that you need to manufacture the chips that you're looking at? If I listen to the big lithography companies, they're certainly struggling to keep up with demand at the moment. There obviously are key areas in which they're focusing as well. Where are the supply bottlenecks? Are there issues that you're going to face in the kit that you need to do what you want to do going forward?
I would say the entire semiconductor supply chain is under pretty heavy stress these days. Now, I feel very confident with the numbers which we gave out earlier because we have supply assured for those numbers. The reality is, of course, I want to do better. And in the short and midterm, it is supply constrained. And it's various things, Guy. It's about wafers. It is about metals like copper. It's about lead frames. It's about substrates. But again, I feel pretty confident. I mean, we said in our analyst day yesterday, we're going to grow at the high end of our longer-term guidance next year. So that speaks about like 12% growth next year. And supply for that is done. I mean, we have that, and we work on the upside to get even higher.
Tell me, where do you think the industry is going to start making all these chips? So onshoring became something very popular over the last year with the supply chain issues, particularly all the port issues in China, their zero COVID tolerance policy. Europe really wants to create and build out their semi space. Is that realistic? Does that happen?
Well, the semi industry has been building in the past on globalization. I mean, everything was about scale, so you had one factory in one place which was serving the world. But I completely agree with you. There is a strong trend to, I would say, technology sovereignty currently in the US, in Europe, and we very much welcome that, actually. Also, the CHIPS Act here in the US, the $52 billion which are under discussion, I think it is needed, and I think it's great that the government is proactive in addressing this.
Well, we really love having you. We love talking through all this stuff with you, Kurt. Thanks very much. It was great to see you in person. That's 2 people in 1 hour in person. This feels weird. All right, Kurt Sievers, NXP Semiconductors CEO. I don't think I've had that in like a year and a half, Guy.
Weird, but utterly fantastic.
Awesome.
Wow, what a difference it makes. And I think I'm only just really beginning to appreciate the fact that face-to-face conversations are so much better than down-the-line conversations. Zoom's great, but it's nothing like standing next to somebody.
Think how much more you
can
can make fun of me if we were face-to-face. I mean, so much more.
That's exactly where I was going. So many more opportunities. Maybe we'll have, well, hopefully soon we'll be able to do that. I look forward to that with a great deal of anticipation. Alex, what have we got coming up next? We're going to change gear a little bit. The US is warning Europe that Russia may be planning a Ukrainian invasion. We're going to have the latest on that story next. This is Bloomberg.
Let's check in on the Bloomberg First Word News. I'm Rishika Gupta. In Japan, the government reportedly is coming up with an economic stimulus package of more than $350 billion. According to the Nikkei newspaper, the package will include benefits for those 18 and younger. Japan's economy is forecast to have slipped back into contraction in the quarter that ended in September. In Germany, the 4th coronavirus wave is hitting with full force, and there's no sign of record infections easing soon. New daily cases have surged past 50,000 this week for the first time. Some hospitals already are overwhelmed with patients. Officials say Germany needs to ramp up its vaccination campaign. And a warning from the U.S. on Russia. Bloomberg's learned that Washington has told the European Union that Russia may be considering an invasion of Ukraine. The U.S. has been monitoring a buildup of Russian forces on the Ukrainian border. All this is occurring as tensions flare between Russia and the EU over energy supplies and migrants. Russia says talks of an invasion is unfounded. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Rishika Gupta. This is Bloomberg. Alex.
All right, thanks so much, Ritika. Let's stay with that story. U.S. Secretary of State Antony Blinken speaking earlier this hour, saying it would be a serious mistake for Russia to attack Ukraine. Want to get the latest now from Emery Hordern, Bloomberg's Washington correspondent. Emery, where's the risk here for a political mistake, a geopolitical mistake?
Well, there's a few at the moment, and things are really brewing in the eastern part of Europe. So first you have this Russian troop buildup, which actually we saw in the spring, about 100,000 worth of troops, warplanes building up on the border. And then that was really tempered when President Biden called President Putin and led to that Geneva summit. Potentially deja vu, because Russian papers actually this week are reporting that there could be a virtual talk between the two for the end of the year, and then maybe again in person at the start of next year. Then you compile this with the fact that there's also this border control issue right now between Belarus and Poland. And because of that, the EU and allies are thinking about putting sanctions on Belarus. And President Lukashenko is saying, if you do that, I am cutting off gasoline. 20% of Russian gas actually goes through Belarus. Chancellor Merkel has called Putin twice this week. She's gotten nowhere with him. Remember, Putin also doesn't really want to do any favors for the Europeans as he's waiting for that go-ahead on Nord Stream 2. But I think there's one calculation of potential risk in the future. Merkel is about to leave. They speak the same language, literally. She speaks fluent Russian. She was brought up in Eastern Germany, and Putin's German is excellent. She is the interlocker, really, for the West and Putin, and she's not going to be around anymore. So I think this is a place in the world we're going to want to watch more closely.
Amory, do we know what Putin wants? Do we know what he's looking for here? Is this about Nord Stream 2? Is this about something else? As you say, last time he wanted a meeting and we got that, was it in Geneva? And as a result of which he calmed down. What is the objective here right now? He tries to play a long game, tactically, strategically. What are we looking at?
Two things President Putin wants. First is a little bit more overreaching. This is an individual who said the breakup of the Soviet Union was the worst thing that could happen of the 20th century. He wants Crimea. He has it. He wants to maintain that control. And you can bet he wants to move that influence well into Ukraine as well. The Kremlin is also talking about the provocation from the United States. They're saying your warships are in the Black Sea. Why are you doing that? If you're going to do that, we're going to have our troop build up. And the second thing, Putin wants his pipeline. He wants Nord Stream 2. He doesn't want any more sanctions on any of these Russian companies. It's ready to go. They've done the test. It's just going through the regulatory proceedings, and he wants that sped up. So there's no reason why President Putin is going to try to help the Europeans with Belarus and his ally Lukashenko when he's not getting what he wants.
Yeah, maybe a fear as well that Ukraine is slipping away a little bit. Anne-Marie, thank you very much indeed. Nice to see you in New York. Bloomberg's Anne-Marie Hordern on what is happening between the West and Russia. It's going to be interesting to see how this one works its way out. We'll talk to the Danish energy minister a little bit later on in the conversation. Let's talk about what we're going to do now. Investors looking for clues on the FOMC leadership. Powell's term winding down. Bloomberg's international economics and policy correspondent Mike McKee joining us now on set. Mike, where are we? I feel like we've been going round and round the wheel on this one, waiting for some news as to what exactly is going to happen. There are lots of empty seats. The key one, obviously, at the top. What happens next?
Well, we've got to wait until the Biden administration, A, settles on who it's going to nominate, and B, finds a window of opportunity to make the nomination. They've been very busy with the Build Back Better. They had to get through the infrastructure plan through Congress. So a lot going on for the White House, but it is about time. Now, let's leave aside for a second the question of the Fed leadership, the chair, because we've talked a lot about Jay Powell and Lael Brainerd. Let's talk about the other seats that have to be filled. Now, if Powell is reappointed, you end up with 3 seats to fill. The vice chair for supervision, which is what they're talking about Brainerd for, and there is an open governor's seat. The qualifications, well, usually if you have a chairman who's not a macroeconomist like Jay Powell, you get somebody like Richard Clarida now who's got deep macroeconomics background. You also want some diversity now. The vice chair for supervision, often a regulator, a former bank supervisor, or a lawyer, and you're looking for some diversity now. As a governor, you're looking for some diversity now and some diverse experience. One of the problems for the Fed, they've had only 3 black governors in history, and there's only been 1 black Fed bank president, Raphael Bostic, who makes many people's lists for one of these jobs. So if you're looking for people who might be on the list, you can look for minority candidates. And here are 4 very highly thought of people. The chair of the Council of Economic Advisors, Cecilia Rouse. Bill Spriggs, he's AFL chief economist. Lisa Cook, she's from the University, Michigan State University. Got to get that right, or the football fans will be mad. And Seth Carpenter, who is Morgan Stanley chief global economist. A couple of women being mentioned for these posts as well. Sarah Bloom Raskin was the Maryland banking supervisor before she was appointed to the Fed, and she went on to be Deputy Treasury Secretary. Karen Dinan, who was the Treasury's chief economist, now at Harvard, also possible candidate for the Boston Fed.
So, Mike, it feels like the conversation is, at least on Wall Street, is who President Biden picks will be more dovish. So maybe he has the opportunity to install 3 more dovish individuals on the Fed. Is that the right conversation to be having? Because if he's so worried about inflation, why would he do something that is perceived as dovish? And also, can we assume that they would be dovish?
Well, there's a political answer and there's an economic answer. The political answer is that the Fed is right now dealing with high inflation. And so, yeah, politically, it's difficult to appoint somebody who's seen as significantly dovish. But the forecasts from all economists are that inflation is going to go back down. And then someday, when it goes back up again, do you clamp down more quickly? Do you stick with the framework that you have now and wait it out? And that's where the new policymakers will come into effect. Also, they have the framework that says they want a diverse labor market expansion, which includes bringing down the Black, Hispanic, Asian unemployment rates. And if you put people in who have lived through those unemployment rates, then you get more sensitivity to that. So there is an argument for going in that direction.
That's a really interesting take. Mike, thanks a lot. Really appreciate it. Bloomberg's Michael McKee. And Guy, what I think is really interesting is that the 2 stories just shows how much President Biden has to deal with right now. And then the 3rd story is what's happening with the energy crisis here in the U.S. and the record high not record high, but very high gas prices. There's a lot of things he has to figure out. He's signing the hard infrastructure bill on Monday. The human infrastructure bill still has large question marks on it, particularly when it comes to the Senate. How does he make all this work?
Well, I think he's got to have a guiding principle in all of this, and that is going to be the American people. And at the moment, the American people, judging by the data we've just seen on our screen in front of us, are worried about inflation. He has to figure out a way of dealing with that. Now, in some ways, the two plans he's put in place may go some way to hopefully resolving some of these issues. They may hopefully raise long-term productivity for America. That would be certainly something that would help with the inflation narrative. But in the short term, I think his problems are absolutely enormous. He has to figure out how to get inflation down and get inflation down relatively quickly.
And $3 trillion worth of spending? I don't know about that one. All right, well, we're going to break down something that sort of relates to this. On Friday, we wind up doing the favorite charts of the week. Mine definitely has to do with the inflation scenario. We're going to bring that to you next. This is Bloomberg. So every Friday, the guy and I are here. We're going to highlight our favorite chart of the week. I'm going to go first, and it's not commodity related. Haha. Okay, so I found the UMich sentiment very interesting. It fell to a 10-year low. That's that white line here. But the blue line is the NFIB small business optimism. It's held up relatively well. It is rolling over, and you have to wonder, does it wind up meeting that UMich sentiment? And what does that then do to hiring, for example, and growth if small businesses and how they feel roll over? What I also thought was really interesting here, Guy, is that you had 24% of households expect themselves to be worse off in 2022. It's the highest since 2008. You really going to go buy stuff if you feel like that? I don't think so.
What I think as well is you can roll into that. You put the JOLTS number from today on top of that. Jobs are plentiful in America, which is interesting that we are seeing this decline in consumer sentiment. Clearly, the inflation factor we were talking before the break, huge element in all of this. I'm going to turn my attention to what's happening with the European earnings season, and I'll make it relatively brief. Everybody was worried going into this European earnings season that things were not going to work out. They did work out. They worked out huge. We've had some really amazing numbers coming through. So what we've seen is, as we come through August into September, we go into that Q3 earnings season, we see the number of upgrades really starting to fade really quite dramatically. Now we've got through the earnings season, we're starting to see a pickup. In fact, European earnings upgrades are now exceeding global earnings upgrades, which is really interesting as people are starting, like Sebastian Redler over at Bank of America, to turn a little bit more cautious on Europe. So we're starting to turn things around a little bit. The earnings season, absolutely pivotal. Talking of which, the European close is coming up next. This is Bloomberg.